This is the Real Estate Power Play Podcast, getting you the information that you need to be a successful real estate investor. Hosted by Mark Monroe, Ronald Walker, Gabe Rodarte, and me, Marty Grizzanti. Combined, we've done thousands of real estate transactions. So get ready for real stories and true case studies on finding deals, growing portfolios, and making money. Welcome to the show.
Hey guys, what's up? This is Gabe with the Real Estate Power Play Podcast, coming to you on actually today is a beautiful Thursday here in Houston, Texas. And just saying what's up from the rest of the guys, Marty, Mark, Ronnie. We have all been blowing and going, and we have some cool stuff to share with you guys. We have Sean here today. If you guys don't know Sean, we're going to send a bunch of links and stuff for you to get a hold of him and in other ways. But I am super excited to have him here because there's just questions we have as real estate investors that we need answers to. And Sean is one of the main guys who knows how to do from the contracts to legal work to helping out with trust. So I got some trust questions myself. And so Sean, welcome, man. How you been?
Gabe, thanks. Hey, I've been well. I'm so grateful that you invited me to be on, and I'm looking forward to it today.
All right, well, let's do this, man. Let's so here's a couple things that we're going to go into. We're going to go into figuring out like, hey, how does Sean get into doing all this stuff? Because I mean, you're an attorney, right?
Correct. Yep.
So you're an attorney, but how'd you get into this space of real estate? Did you just start this space? Did you just jump into it, or what was how'd you get started in all this?
So it kind of goes all the way back to the foreclosure short sale days.
Okay.
I did a lot of work in that space, a lot of foreclosure short sale consultations, presentations on, foreclosures and short sales back in the 2008 to 2012, 13 period. I developed a lot of contacts through that within the real estate world, a lot of brokers. And then fast forward to, maybe 2016, 2017. And I was invited to speak at a Association of Realtors event out here in the East Valley of Phoenix. And my co-speaker was Steve Trang, who I don't know if you guys know, but I met Steve, and we chatted and communicated after the event, ended up having lunch together here or there. And then one day he's like, hey, I do this meetup called Real Estate Disruptors. And are you interested in doing this meetup and sponsoring it? And I'm like, yeah, let's do it. And so didn't really fully appreciate what I was getting myself into. And so I sponsored the event and showed up, and there were like 500 people in attendance. And then Steve gave me a few minutes, as he does to the sponsors, to kind of talk about their practice. And next thing I know, I have all these real estate investors coming to me and, hey, can you do this? And can you do that? And let's, go forward and figure it out. And then from there, I've developed more of a niche, and I still do the wholesale novation work and work with investors in that space, probate as well, and those types of things. Our firm has 8 attorneys, and so we have our hands in a lot of different things, from litigation, probate, that type of stuff that we work with real estate investors on. But my personal practice now and my real niche is creative finance.
Cool.
Is structuring creative finance transactions, developing documents for different creative finance structures and transactions. And so that's what I'm doing. And so that's how I kind of ended up in the space. It, didn't fully appreciate it until, I had that chance to sponsor the event. And then I'm like, oh, wow, this is, I really like the collaboration that these investors have with each other. And I'm like, oh, this is something I want to explore and become a part of. So that's how I ended up in it.
That's awesome. And it's crazy because there's a massive need, right? You probably showed up and goes, wow, there's a huge need for what you're doing here. And a lot of service to be dealt to everyone, from newer to older investors that have been around, anything that has to do with real estate. I mean, it's so important to have someone who has your back and someone you can hop on the phone with and get a phone call quickly So, and everybody needs that guy. You know, I
Right.
was just on a call yesterday, and someone's like, "Man, I need an attorney that knows how to handle HOAs, because this HOA, and we're trying. It's a unique situation, but they're just wasn't a typical neighborhood, kind of like one of those outlier neighborhoods that still wants control of your land, and you're like, that's not even. It was 40 years ago, so." This is awesome. So there's a lot of great stuff. So the exciting thing. So I have questions. So here's one of my go-to questions that I'm just asking because you hinted on it. You're saying the creative finance, you're really hitting on this thing. Are you hitting on it because, I mean, I'm guessing you're seeing a massive need. Is that because you're seeing the market shift there, like the real estate investor market shift there? Or is it the general real estate market in whole as a nation of March, 8th, 2023? Like, what is it, both? Like, what are you seeing?
Yeah, so it's a combination. How I ended up with this niche is a combination of two things. One is I have a lot of clients that, are pretty big players in that space. And so they work with me to, help them structure their transactions and set up their contracts and put those together. And then second is, as I watch the market, I see that that's going to be the trend. That's
Right.
going to be the thing that's going to be necessary as interest rates go up and our appreciation starts to plateau, and you're not seeing the market with the rampant appreciation. Well, wholesaling is not as attractive then, right? It's more about getting in there, finding a property and cash flowing that property. Well, you're not going to do that at 7% interest. But if you can find a property that has a loan that's a couple of years old at 3% interest, that makes sense.
Right.
And so, or if you can convince a seller to do a seller carryback at a lower interest rate, that makes sense. And frankly, unlike wholesaling where you're trying to, have the property under contract to, 50 to 60, 65% of fair market value, on creative finance, you can make a transaction work by actually paying a little bit more than fair market value, because what you're doing is you're buying the interest rate.
Right.
That's what you're doing.
And the reality is, I mean, correct me if I'm wrong, but isn't that what people are doing with buy downs anyways, is that they're buying an interest rate? I mean, even on new build communities that they're doing, they're going to banks. And so it's interesting, like a couple of years ago, buy down, or just paying for more, I guess you could say, for the property was kind of like it's an outlier conversation. And now the conversation, I can imagine, is becoming easier for you because you're like, oh yeah, well, my mom just did it, or my cousin just did it, or someone I know just did it on a house they just bought because they couldn't get into the home without putting more money into getting the rate lower.
Right. Yeah, that's exactly right. I mean, so even outside of the investor community, there's a strategy there from somebody just that wants to own or occupy,
right?
Where they may be willing to offer a little bit more in order to be able to buy down that rate and get in there at the lower interest rate.
So I'm guessing you're referring to things like sub 2. You said seller carryback. Let's dig into those for the audience that's listening here. We have from beginners to novices, and we're all over. We got guys in Michigan, New York, Florida, Oklahoma, Texas. I'm in Texas, all over Texas. Let's go through it so that way we can just understand where the market's at and the creative side of it. So the creative side of sub 2, I think everybody really understands that. And so let's just dig in and let's hear the Sean St. Clair's synopsis of like, hey, why sub 2s are so important for you.
Well, I mean, it does get back to the ability to acquire the property without any funds out of pocket. And so obviously you're looking at the numbers, you're looking for cash flow, both, short-term, long-term, or you're looking to put it under contract and then you could assign a subject to or a creative finance transaction. So if you have good seller carryback terms, another investor, even maybe a homeowner, may want to get, take it on an assignment and close on the transaction. So that's why creative finance is so important, is you can basically acquire properties with very little out of pocket. there's three main methods to do that. So when we talk creative finance, there's two types of creative finance. There's subject to or sub to that you referenced. That's where the existing mortgage loans remain in place and the buyer comes in and does what we call a silent assumption of those loans, meaning you don't go to the lender and approve an assumption.
Right.
You do a silent assumption. You assume them by agreeing with the seller that you're going to pay those monthly payments. And then the second type is seller carryback financing. That's where the seller owns the property free and clear, and they're going to become the lender, and they're going to provide the financing. And then there's this thing in the middle called what I call hybrid, which is you're going to buy it sub to, but there's equity. And so the seller is going to become the lender as to the equity and carry back the equity. But those are kind of your three traditional creative finance structures. And then there's the means to accomplish those. And those fall into three buckets as well. So the first is to do a warranty deed with a promissory note and deed of trust to the seller. So if you're going to do a subject to transaction and the loans are going to remain, you're going to do a wrap. Wraps have been around forever. We don't really use that term in the investor community, but actually I want to use that term more and more, is a wrap, because judges understand wraps, attorneys understand wraps. They don't understand sub to or subject to. They understand the term wrap. And when you say wrap, they say, oh, okay, you're doing a wrap transaction. So we're going to wrap. If it's a subject to, and we're doing a traditional purchase with a warranty deed, we're going to then wrap it by giving the seller a note and deed of trust. And what that note and deed of trust is going to say is, I am going to perform. And what I'm going to do for performance is I'm going to pay your mortgage loan every month.
Right.
So it's a performance note and a performance deed of trust. Now, if you're doing seller carryback financing, then in that case, it's not subject to. If it's just straight seller carryback, the seller's going to give you a warranty deed. So you're going to take title to the property, and then you're going to give the seller, who is now your lender, a note and deed of trust with mortgage with your traditional terms of, here's how I'm going to pay it. It's going to be X percent of interest, monthly payments of interest only or amortized. There's going to be a maturity date, and you're going to structure it just like you would any other loan, and you break it down, and that's what you use to close that. So that's the first bucket or way to set up a creative finance transaction. The second way is to do an agreement for sale or contract for deed. And or some states call it an installment or land installment contract. And it's basically where you agree to the seller to pay over time. And once again, you can purchase it by subject to, or you can purchase it by straight seller carryback, where you tell the seller, okay, I'm going to pay you over time. I'm going to make these monthly payments to you. And then when I finish making these monthly payments, you're going to give me a deed to the property. So a deed's not recorded. What's recorded is the actual agreement for sale, contract for deed, or installment contract. And the difference between that and, say, just a regular purchase contract is where you agree to close escrow at some, future time, is that you actually receive possession of the property, and you receive the right to go in, possess the property, repair the property. You're obligated to pay for the taxes and insurance on the property. And you basically assume full control over the property. The only difference is fee title, or title to the property doesn't transfer. You have an equitable interest in the property and a right to purchase the property and not purchase it, but obtain fee title at some future time. And then the third way, go ahead.
Wait, before we go there.
Sure.
So for those who are listening, I think most of us understands this first bucket. Okay.
Yes.
The second bucket, I think the part that I hear most people, and I talk with our guys in the Power Play, we always have good conversations about this. I think the part is going, when do you want to apply that? When do you want to apply the second bucket of creative financing? And so what's the benefit of that for those who need to know compared to the first one? That's kind of traditional.
Mm-hmm.
Like, it's pretty easy to take over someone's note and you're going, okay, you're at 3.5%. Sure. And we'll go in that route. So where it's, go ahead.
Great question. So the first bucket, when would you want to do that? Whenever possible, whenever possible. Okay. Now the second bucket is reserved for when there's issues with the property. An example would be, there's title issues out there. There's judgments out there. And those issues can be resolved. They normally can always be resolved. It's time and money. Time being the biggest issue sometimes. So if you have to go into court judgment or court approval to strip liens, to strip judgments from the property, then, for example, we have a client right now who has a bail bonds lien. It's been satisfied, but we have to get the bail bondsman to release. Well, that company's out of business. So now we're going to have to go to court, and we're going to have to get the court to say, yes, it's released. The conditions have been satisfied. Well, the buyer wants the property and they want it now. They don't want it 6 months from now.
Right.
So what you can do is you can do an agreement for sale and then provide that you're going to convert that transaction to a traditional transaction with warranty deed and a wrap once you get these issues resolved.
I love it.
So it allows you to get in there, to have possession, to make improvements, knowing you've locked down the property, but title's not going to close it because you have a title issue.
Yeah.
Another scenario would be divorce. So let's say the seller is going through a divorce and there's already been an agreement between the parties that one spouse will receive the property. However, there's other issues like child custody and spousal maintenance and child support and things like that that haven't been worked out. Well, because those haven't been worked out, no divorce decree is being entered. Right. So technically the spouse that is going to receive the property, and there's no dispute about it, doesn't have full legal title to the property and doesn't have the right to convey it. So you could do an agreement for sale with that one spouse, which basically says upon the decree being entered, then we're going to convert an agreement for sale to a warranty deed with your wrap note or performance note.
So basically after the divorce happens, you go and you just file the rest of the paperwork and you're good to go.
Yeah, there's a process. You generally will deliver a warrant. You'll have an escrow agent. You'll deliver documents to the escrow agent and they'll close it and give title insurance. But they're not going to give title insurance right now because there's no decree.
There's
actually.
No way.
Yeah. So it's those types of things when there's some issue with the property. The other issue could be due on sale clauses. So we hear this thing about due on sale clause.
Right.
But I'm not sure anyone really fully appreciates or understands the language. And with that said, not every due on sale clause is the same. So if I go and I look at a Fannie Mae Freddie Mac deed of trust, and I look at an FHA deed of trust, and I look at a VA deed of trust, and I look at a local, private credit union deed of trust, and I look at a private lender deed of trust, for the most part, the due on sale clauses are going to be different and they're going to allow for different things.
Right.
And so you may have a due on sale clause where you're like, oh, well, I can do an agreement for sale or a land installment contract and not violate this.
Right.
And so you do it. And then you just do it. You don't convert it because you're like, I don't want to mess with the due on sale. I'm just going to do an agreement for sale. And then when I finish paying everything off, I get the warranty deed. Okay. Then the loan's paid off. You don't have to worry about it. Right. So that's an example of when you would do that.
That's awesome. Now, is there a third bucket you said?
Yes. Third bucket.
The third bucket. Here we go.
A lease with an option to purchase.
A lease with an option to purchase.
Yeah. So that would be, say you enter into a long-term lease, like a 5-year lease. And then you enter into an option to purchase the property at some future time for a specified amount. It could be as simple as, I'm going to purchase it at this future time for, and this is important, this would be important language to put in there, for the principal balance of the existing mortgage at the time of closing. That's your purchase price.
Nice.
And so what then you do is you enter into this lease, and your lease says that your rental payments are basically the equal to the loan payments. So what are you doing for the next 5 years? You're paying down the purchase price set forth in the option.
That's awesome. That's awesome.
So the reason why you would want to do that, so that one is one of those things where you can do it, but the downside to it is there's certain tax benefits under an agreement for sale and a wrap transaction that you can take advantage of.
Basically, you're acting as a tenant.
Yes.
In a sense. And tenants don't have very many
depreciation, mortgage interest deductions, those types of things that you'd be.
You're only getting the appreciation of the property that you take over.
And if you put a tenant in there, you get the spread between the existing loan and whatever you can garner and rent from a tenant.
But you still have control over the property.
You still have control over it.
That's the key.
Yeah. And you would do that primarily if you're concerned about the due on sale clause, and you look at the due on sale clause, and most due on sale clauses are not going to prohibit the lease of the property. And so, nor would they, some do, don't hold me to this, because there are a few clauses that do, but a lot of clauses don't prohibit options either. Because if they prohibit options, then they would prohibit a purchase contract, because it would basically be an agreement to purchase the property at some future time.
Right.
That's the language. And there are due on sale clauses that have that language. And you're like, wait a minute, so I can't enter into a purchase contract, right?
Yeah.
So generally, the lenders are not going to, exercise the due on sale clause for an option. And so if you're really concerned about the due on sale clause, you can acquire the property with a long-term lease with an option to purchase. Give it 5 years, and then figure out how you're going to dispo it at that point.
Got it. Wow. So this is good. Bucket 1, 2, and 3.
Yes.
This is something that everyone's going to want to listen over again. This was really good. That's probably the clearest explanation I've ever had of them. You got it down, bro. So this is fun. And it's cool to go over it again, to listen to different people explain it, because you just gave me some insight on some things that I'm like, oh, this is, I know why we create these things. This is why we're doing it. We're talking to the sellers. We're talking to just our team in general and title companies. And I think one of the things that people miss out on, especially if you're just getting involved in real estate investing, is that there's some decent amount of money to be made. You can create a whole business just in working with sketchy title work. And you need to know these other exit strategies, and that there's actual paperwork and documentation you can go about. If you could come up with a creative idea, you need to bring it by an attorney and go, hey, does it fit one of these things? If you talk to Sean, and Sean, you got a Facebook group, right?
Correct. Yeah. It's called Real Estate Investor Legal. And the purpose of the group is to basically connect investors with attorneys who are investor friendly, throughout the nation, title companies as well, even some other professionals like realtors and things like that. But it's primarily designed to connect investors with professionals who understand and appreciate and want to work with investors throughout the country.
That's awesome. And they could just ask any questions on there and find out who's who. And this is key, because I think that's the question we get a lot also. So this is awesome. So we got bucket 1, 2, and 3. Now, what this does is help us get control of the property so we can use it as an investment, right? So most of the time, these are for longer term strategies. These are not strategies that you're going to do and just hurry up and move it over right away. I don't suggest that. I mean, I know people who do that for sub 2, where they get a sub 2 and they hurry up and flip the sub 2.
Yep.
But I mean, we're talking about, this is where the net worth is built, right?
Right. Yeah. I mean, wholesaling is great. And a lot of people have made a lot of money and become millionaires, frankly, off of wholesaling. But when you turn 70 and you're like, I don't want to wholesale anymore, where's your income going to come from? Right.
Right.
But if you have a portfolio of properties that are cash flowing, why do I need to work anymore? I have this income stream coming in.
Right.
And so that, really the creative finance, the acquisition of properties for cash flow, that's a long-term game, and you're looking for this to basically fund you for the rest of your life, is what you're hoping to do.
Now let's go to this is a passive game, but it's not real passive. It's not where you're putting your money into a machine and it's just pulling and stuff out. You have to maintain these things, and these are real assets. You're going to, there's, if you're using it as tenants, or if you're going to do a seller finance and you're financing it to somebody else, which is another question I want to ask. You got to maintain this stuff. So once this stuff gets put into play, what can someone be expecting? Are they going to be, looking over this thing every year, or once these documents are filed, like you said, 5 years from now, let's go in?
Well, if you put a tenant in there, which is how it's going to cash flow,
right.
Then obviously you're either going to hire a property management company that's going to do all the work for you, or you're going to be, doing the work yourself, right?
Getting the calls yourself.
Getting the calls yourself. And the same for a lot of people want to use these as Airbnbs. And so that's great and all, but being an Airbnb host is a lot tougher than being, say, just a landlord.
Right.
So if you're going to do it yourself and you're going to be the host of the properties that you acquire, expect that cleaning person to call you at 10 a.m. and be like, I'm not feeling well today, I can't clean the unit. And you have a guest coming in at 2, you're dropping everything.
Someone's
and you're running over
something.
and cleaning your unit, right?
Someone has to clean that thing.
Yeah. Or you can hire a property management, or I shouldn't say property management because that's not accurate. It's called a co-host.
Right.
Or a short-term rental manager who's going to manage that. And they will then, if something happens, they're going to receive the calls. They're going to deal with, the cleaning of the unit and maintenance and stuff like that. So, it depends on what you're wanting to do. Do you want to do yourself and save the 10, 15%, or do you want to just, go out and acquire properties?
When we first started, Sean, I was doing a lot of this stuff myself. Because I came from that world and I came from the rehab flipper world. That's really the world that I knew the most because I had construction crews already. And then I enter into this world and I just thought everything was touched by me. The people I talked to were like, everything's touched by you, Gabe. This is just how it works. And I had to really branch out and go, okay, I need to find other solutions to really duplicate my time. And there's a lot to be said about having the time for mental clarity and not concerned. I remember being at a gala one time, and my wife and I were at a gala. It's Saturday night, and man, my phone was blowing up. There's a flood in one of our houses from a pipe burst. It wasn't even wintertime. It was just like a weird random thing. And so I was like, what do I do? It's Saturday night. Like nobody's leaving their house at 10:30, to come do this. And that's when I made the decision. I'm like, I think it's about time for me to look for somebody else to help me with this stuff. So let's keep moving forward. This is great. So can you wrap an already wrapped note? If you have you took a property over sub 2, and instead of doing, you want to put a tenant in there, you found a buyer for the property. There's a lot of equity in this thing, let's say. Can you go ahead and put a note on that?
Sure. You can wrap the wrap.
You can wrap the wrap. This is what we like to hear.
All right. And so you basically, and of course that's going to be more of your hybrid scenario because, you don't want to just wrap an existing wrap where you're paying the mortgage because where's your spread? So you're going to say, okay, here's how much you're going to pay. Now what you're going to do in that case is you might structure a little bit different and just do a traditional note with monthly payments that are greater than what you're paying under the underlying obligation.
Right.
So let's say you're paying $2,000 a month. You're going to enter into a note with a buyer where the buyer's paying $3,000 a month. And so that's what they're going to pay under that note. So you get the $1,000 spread, and you can have different, terms and maturity dates and things like that. Now, one caveat is there is this thing in federal law called Dodd-Frank.
That's right.
And so if you're selling to a buyer who's going to own or occupy, Dodd-Frank kicks in. And the rule is, as an investor, even if you try to do multiple entities, Dodd-Frank has said, no.
Right.
If you have a controlling interest in all these different entities, you're one and the same, even if you're buying it in different entities. But basically, as an investor, you can do 3 of these seller carrybacks a year where you sell to an end buyer who's going to own or occupy the property. You can do 3 a year, but the terms are pretty restrictive on what you can do. So, no rate adjustments for the first 5 years, fully amortizing. You have to confirm that they have the ability to pay, and, you have to underwrite them yourself. However, if you go through a licensed loan originator and they underwrite the transaction, you can do as many as you want, and you can do whatever terms fit within that loan originator's matrix. So that loan originator is going to tell you what terms that they can underwrite and that type of thing for any particular borrower. And then you can go through them and you can do as many as you want.
Way to go about
Oh,
doing
yeah, exactly.
to do an RMLO and then have them go through the whole thing for you.
Yep.
That's what we do on our stuff. And I just don't like, I just like to sleep good at night, so that's what I tell people. Like, look, I like to sleep good at night. I know you do too. Let's go this route. Definitely when you're talking to the buyer, they want to know that they bought a good deal. And it, so that's what you're really setting up for in the future. And it's actually a perfect scenario.
Right. Yep.
Yeah.
So you can wrap the wrap. You can do another disposition method for a wrap. So that first bucket is a lease with option. So you can sell it to an end buyer, but you're going to do it with, they're going to lease it. And it's not a lease to purchase. Never use that term. Nobody should ever use lease to purchase. It's a lease with an option to purchase, and they're two separate documents. When you do lease with or a lease purchase, then you're contemplating that a portion of the rent every month is going to go towards the purchase of the property, which then creates a property interest as opposed to a possessory interest. And then you're going to have a difficult time, at least here in Arizona, with evictions if they breach. So it's a lease with an option to purchase, two separate documents. And the lease should not, or at least when I draft them, I do not have the lease reference the option. The lease is just a lease like you would with any tenant. And it should comply with the local state's Residential Landlord Tenant Act, the whole thing.
Got it.
And then the option is a separate document. Now the option does reference the lease as being a lease in performance provision, which says, hey, if you breach the lease and you're evicted, the option's no more. And so you do a lease with an option to purchase. So you can do it that way. You can also dispo with an agreement for sale or a contract for deed if you wanted to do it that way as well.
Wow. So guys, this is the cool part of knowing like people who know how to do the many different forms of creative financing. Let's go do some things, man, that you're probably like, man, I talk about this all the time, but the epic big novations. I think that people, I missed out on this, man. Like the wave of novations when it was all happening. We're moving into doing a lot more commercial type properties, and I didn't really know some of this stuff. And so we were not doing some of these strategies. And, but I was still doing them by basically just buying property and doing light cleanup or just something minimal and then throwing it back on the market. So basically a hotel, I guess you could call it. But now we have novations. They've been around for a while. So let's dig into that for those who don't know.
Yeah. So couple of things, and I'll give a disclaimer. I probably should have provided one earlier in the show, but nothing I say here is legal advice. Check the laws of your state regarding, any particular transaction, and consult with a competent attorney regarding any transaction you contemplate to do, including novations. And I say that because novations are one of those riskier transactions. I mean, there is some, you're taking a greater role in the transaction than say a wholesale or even creative finance, because you're going to be working with the seller a lot closer when an end buyer is identified and those types of things. And you have to make sure that you're going to be compensated. So let's just talk about what a novation is and how it works. So basically, the way a novation operates is you enter into a purchase contract with a seller. And the purchase contract states, or an addendum to the purchase contract states, that the seller may enter into a contract with another buyer, a whole separate contract with an end buyer. And that contract will replace the investor's contract. And the way the investor is then compensated is they are paid the difference between their purchase price and the purchase price in the end contract, or some percentage. You could do 80%. So the seller gets a 20% kicker, right? But you say, I'm compensated and I will be paid the difference between what I have in my purchase contract, what I have for a purchase price, and what the purchase price is on the final contract that closes escrow. And I'm paid this in order to give up or cancel my legal right to purchase this property and to release my memorandum. Now, research the laws of your state regarding memorandums and when you can record and not record. Here in Arizona, the purchase contract has to state that you have a right as a buyer to record the memorandum. So you record the memorandum, and it says, in order for me to release the memorandum and cancel my contract so you can close with this other buyer under this new contract, then I get a cancellation fee or a release fee of the difference between the purchase price of my contract and the purchase price of the end contract. Because what a novation is from a legal side of things, if you pull up Black's Law Dictionary and you look up the word novation, it will be in there. And a novation is a replacement contract, a contract that replaces an existing contract, that it trumps, it cancels the existing contract. That's what the legal term novation is. So that's the basics of it. And I would say, if you want to know how to do it, this is a transaction that you need an attorney to give you the kind of the final ins and outs, because every state is going to be a little bit different on how you do it or if you can even do it. So I probably would not go into that, any further as the other documents and, your role in
well, what's interesting, we used to do a thing called pass-throughs, and it was very similar to something like this. Where we're still on the title. We're still able to, our names weren't on the title as far as that, but we're still on the closing docs at title. So that was very helpful. They stopped doing those, but it's cool because then this is one of the things that I like about real estate is some people approach this as if like a one and done thing. And that's really the asset side of it. And that's one of the things that I didn't know in the beginnings, Sean. Like I didn't know that there's all these other moving parts before the actual real estate. The real estate is just the hard asset, and there's all these other things. So, when you look at the passive side, the rental side, the getting cash flow from a B&B or whatever it might be, once you get into it, there's a real estate side of it, and then there's the side before that, right? And that's the marketing and you're trying to get a hold of the seller, and you're doing all these negotiating, you're talking to your attorneys, and that's really where the creative side and where the cash flow, where the money's made, all the stuff is actually happening outside of the property, really. I mean, there's only so many things you could do to a single family home or a fourplex, right? So per the neighborhood, all these other creative things is really where your cash flow and your passive stuff is coming from.
That's right.
Right. So this is pretty exciting. So, man, we went over a ton of stuff. And from what I'm hearing, and then the market conditions and where we are, March 2023, guys, this is something to get a hold of. Like, you need to get a hold of an attorney in your area. Sean has this stuff. Sean, say the website again, or the Facebook page again.
Yeah. So the Facebook group is Real Estate Investor Legal. And look, if you can't find it on Facebook for one reason or the other, just friend me and I will send you an invite.
Sean he has a lot of friends. He doesn't. He's slip into his DMs.
Yeah. Well, I generally will allow them to stack up the friend requests a little bit. So it takes a few days, and then I'll go through and we'll accept them. But yeah, normally if an investor reaches out, sends me a friend request, then I always just send back an invite to Real Estate Investor.
And then what's the best way to get a hold of you personally? Is it just friend request, or is your brokerage now, like, you guys are doing so many things, you're saying probate and some other stuff also? Like, so
the best way to reach me, this is the absolute best way, is to call, and I'll even give you my direct line phone number.
Wow.
It's 480-359-7206. Call that number. That's the best way to reach me. And if you want to set a consult with me and it involves an Arizona issue or an Arizona property, or you're an Arizona resident and want to talk about creative finance, those types of things, then you can call my direct line, which is 480-788-9911. Or you can go to our website, www.Fowler, Fowler, St. Clair, STClair.com, and you can schedule a consult with me.
Yeah, and I'm going to put that in the show notes because I was looking at your guys' site actually this morning and going through different stuff. I didn't know you guys did all those things. So, man, it's awesome. And I love this business, Sean, because it's the power of a network. And one of the things I share with my buddy, we do some storage stuff also. And we're like, man, realize that in the world we live in now, Sean, like all it takes is 5 phone calls. Like if you can run your business and all it takes is 5 phone calls, that's amazing. Right. And you get to a place where you're just going, yeah, well, you get it down to just 3 phone calls. And then, but this, like, what other world can you live and do so much great stuff? And you're having a business and it's successful and you have cash flow and you're able to build just by making phone calls, connecting with people, and just building relationships. So this is the part I love the most about doing the podcast and doing Power Play and helping people, because they'll text us saying, hey, I really need some help for this next step. I don't have all the answers. And I'm like, hey, just call this guy up. You got it. So guys, thank you so much for joining us on this. If you've liked this, if you have other ideas, other topics that you want us to go over, be happy to go over those things. On behalf of the Real Estate Power Play guys, see ya. Have a safe trip. Bye.
Bye, everyone.
This has been another episode of Real Estate Power Play, guiding real estate entrepreneurs to a brighter future. If you liked what you heard, consider subscribing wherever you listen to your podcast, or follow us on YouTube at Real Estate Power Play.